Welcome to Oregon Cash Flow Pro. My name is James Barber. I'm always here to help you maximize your cash flow. Yield Max ETFs. They're all the rage. That, along with a number of other high yield dividend ETFs. We're going to address those today in this video. I talked about them a bit. I own some of them. But what do you need to know about them? Are they a scam? Are you better off in something else? There are things that you need to know. Can there be a certain place for these in your portfolio? Does it work for a certain type of investor? Stay tuned. We're going to get into it. And I've got a shout out for another small channel out there who's putting out some incredible videos if you do own some of these. So I'll tell you that here in just a little bit after we get into this. But first, let's start with, are these things a scam? Can you do better in something else? Can you do better if you just buy the underlying? Like, that's the main argument, right? Let's look at one of the most popular ones, MSTY. Since its inception, it's up 286% when you account for the dividends, while the underlying up 479%. So there's an argument out there that says you should have just been in the underlying and you would be way up. If you want income, you can just choose to sell a little bit of MSTR each week and you would be better off. And that might actually be true. If you run the numbers and you owned the same dollar amount of MSTR when this started, and you just sold a little bit each week to get the same payout that MSTY got, you probably would be better off because this is a much, much bigger return than this. I mean, this is still good, but this doesn't happen unless this happens. Like, MSTY is not going to be up that high without MSTR taking off. And MSTR experienced so much volatility. Now, MSTY makes its money by selling covered calls and doing some other things. They might enter some spreads in order to make income that it then pays out as a dividend. So if you were to just sell shares of MSTR, you probably could have done the same thing yourself, and you would probably be better off for it. Well, I say you. We should say the theoretical investor. Now, the reason I say the theoretical investor is because the actual investor has a hard time with volatility. The actual investor, while they may have really liked MSTR here, they might have been concerned about selling some of it here and taking that income. And maybe they just get out of it and they miss this. And then they buy back in somewhere over here. And then it goes down again. And then they sell. And then maybe they buy in over here. And maybe they catch some of this ride. Like, that's what actual investors do. At least people that pay attention to the market. The really good investors buy and hold. If you can get good at buy and hold, you can just identify the best performing companies or what you think might be the best performing, and maybe you get to take full advantage of all of these gains. I'm not that type of investor. I can't. I watch the market too much. If I see something going down, I don't want to hold it. So where I've found a home in the market is selling covered calls for income, selling puts, making premium. That is essentially what these income ETFs are doing. They're making income. When I get into a covered call strategy, if I do a poor man's covered call or I decide to run the wheel, I don't necessarily expect to beat whatever it is that I'm trading. And I'm okay with that. I have a goal. And my goal when I'm buying and selling calls and puts, my goal is to earn income that gets me a certain amount of money based on the capital that I put at risk. And as a percentage, it should do really good. And it doesn't matter if the underlying stock is going up or going down, because we can do that in all kinds of markets. And that's what these ETFs are doing. So the people that these ETFs appeal to are people like me, people that would already be doing this type of strategy. But I don't want to sit in front of the computer all day long and trade. I've got other things that I want to do. I want to go work out. I want to go spend time with the missus. We've got work. So we just can't do it. So this is a way that we can outsource our selling of covered calls. And this is where I'm going to give that shout out. There's a YouTube content producer. Their channel is ETF Inspectors. And he will go through, I know he does on a couple of these tickers at least, but I think he does it on a lot of them. LFGY, ULTY, MSTY. He goes through all of the trades that they're doing. So like you can go in there and look and see what shares are they holding, what calls are they selling against those shares, how are they managing their trades? And like it's complicated stuff. You need to know options really well if you want to be able to take advantage of selling premium and making an income. And a lot of people can do it, but a lot of people can't. And some people, if they know themselves, they're not cut out for it. Or maybe they don't have the time to do it. And these income ETFs provide a way that you can outsource that to somebody else who does a good job of it. And that's where I like those ETF Inspector videos, is because you can see, are they actually doing a good job? If they're doing a good job, essentially what we expect is that the income that it pays out over time will eventually pay for the shares that you bought. So if you just put in a lump sum of money, you put in $10,000, the income that they make off of that selling covered calls and they pay out as a dividend is going to come back to you, and it'll fully pay back your shares over the next year or 2 years or 3 years. And at that point, it's all profit. This is essentially how I look at it when I get into a poor man's covered call. You buy a deep in the money call, you sell puts against it until that call is paid for, and then it's all profit from there. Now that underlying long call can actually make money as well, which is exactly what's happening inside these ETFs. But when I get into that trade, the expectation is it's going to take a while to make the money back that I paid for that call, and then I'm going to profit. But I'm only going to profit up until I get to the expiration of that call, and then I've got to do it again. And as long as I have capital, I can continue to keep doing that. So if I do good selling the covered calls and the long call profits, or I have downside protection, I can ensure preservation of capital and an ongoing income stream. Okay, so 3 years down the road, the shares are paid for, and it's going to continue kicking off income because that initial underlying amount that I put in, they're still making money on it. They didn't lose it all, mostly because they're good traders, and hopefully the underlying didn't go to zero. So there is a risk that the underlying can do terrible, in which case we don't see 200% returns in here because the actual underlying didn't do that good and it lost money, and this is going to lose money as well. So there is some risk here depending on what type of ETF you're getting into. Is it a single stock risk? Is it a basket of stocks that they're doing? Like ULTY? ULTY has a whole bunch of different stocks that they're utilizing, and they've changed their strategy, and it's turned around. It's done really well for the last couple of months. And it's due to the change in strategy. They're no longer losing that NAV. But the key here is that we get into it knowing why we're getting into it. We're not getting into it because we expect to get 1,000% return in the next couple of years. We're not going to have a breakout like this every other month. That's just not going to happen in these because the upsides are capped. We're not going to be able to participate because we're selling covered calls. Well, the ETF is selling covered calls against the shares. So how do I like to look at these, and where should we consider them as a place in our portfolio? These act like an annuity or like a rental property. If you have a chunk of cash, you go buy a rental property and it's just going to pay you over and over and over again until you get rid of it. And it's going to depreciate. It's going to fall apart, and you're going to have to put money into it to maintain it so that you can continue to rent it out. And it's the same thing here. As it pays out, if the underlying is dropping or the dividend ends up paying out more than it's growing, you've got to maintain it by reinvesting those dividends, get your number of shares up so that you can keep getting that same amount of rent, because otherwise it's going to go down. So like when MSTY's at $20, it's probably paying out a bigger dividend than if it's at $10 or $5. It's the same situation. That's the depreciation. The payout becomes less, but hopefully if we're in good ones of these, we've already made our money back at that point. So it's all profit. Now there's another thing to consider is taxes. Once you get your return of capital on these, it's all taxable income. But when I'm trading and selling premium, when I'm selling puts and I'm selling covered calls, I'm paying income taxes on that as well. So the theoretical investor that can sit and hold and sell off when they need income, like they can hold for over a year and pay long-term capital gains. There are tax advantages to being able to buy and hold. But for an investor like me, getting that payment has a lot of value in it, even though we know that we're going to be paying income taxes on it. I mean, it's income, especially once we pay for our shares. It's income, so we'll be paying taxes on it. It's not the most advantageous way to go about it, but it might be what actually works to keep me invested in the market. Now, how I like to look at it is a supplement to my trading, because I like to do my own selling of covered calls or running the wheel strategy and making that premium, but I don't do it with all of the money in my account. And so if I have extra money sitting in my account that I'm not putting out at risk with me doing the trades, I could be putting it into doing things like this. Now, I really like doing these inside of a retirement account. Retirement account, great place for buy and hold as well. But for me, because I'm in the market every day, I'm looking at it. I have a hard time buying and holding. So I have an account that I don't look at. Those are my buy and hold accounts. I don't look at those. But there are some that I like to trade. And those are the ones I really like to do all of my selling premium in and things like this. Now, in the after-tax accounts, in the brokerage accounts that I actually have to earn money, because like I have a job. I make money at my job. I don't need to make money here trading in my after-tax accounts. And so I'll usually just focus on trading in my retirement accounts where I don't have to worry about paying the taxes each year. And usually they're in my Roth. Like that's where I try to have everything in it. So I don't have to worry about paying taxes in the future on that. But if I have access to cheap money, why would I not use it, make some money selling premium or putting it into something like this where I can make money with it? Case in point, I'm going to be doing a challenge here in the next couple of weeks as soon as I get the funds transferred. I've got credit card companies that are basically throwing money at me at very, very low interest rates. So I've got 3 cards. Now it's 3 cards that I carry no balance. I might charge 1 or 2 small things on them just to keep them active, but I carry no balance. And so they send me an offer. Hey, we'll let you borrow as much as you want up to your credit limit for a 4% transfer fee and 0% interest for the next year. Okay, I could borrow for essentially 4% for the next year. Can I beat that selling covered calls or selling puts? Heck yeah, I can. So give me that money. I had another credit card basically there was 3 credit card companies that all offered me special deals. 2 of them 0%. One of them was a 7.99%, but it's like there's no limit on when I have to pay that back other than I'll pay the minimum payment. So at 7.99, I can still beat that. It's a bit harder, and we're going to be making sure that we track it. But we're going to have some things in place to ensure that we can do well in this challenge. So the challenge, we're going to start it in a couple of weeks. Once I get the money moved, we're going to probably have $40,000 that I'll have available, that I'll be able to run the wheel strategy. We'll be able to do some other things, and we're going to share it here with you guys so you can see what we're doing. And our goal, how quickly can we pay back those credit cards? Definitely we're paying off the 0% ones that we only get 1 year of 0% because those get paid off. We don't ever pay credit card interest rates here. We pay those off before that point. So that's the goal. What strategy can I employ that I can end up paying those off and I'll still have all that capital or more at the end of it? So we're going to go a year from now. We're going to try to make at least 20 grand with the capital that we get from it. And regardless of what we make, whatever we make, we're going to still have the capital to be able to pay those cards off when the time comes. So anyways, it should be a fun challenge. If you want to watch that, be sure to subscribe to this channel. Keep up to date. These income ETFs, I think they're great. I've listened to a number of interviews of the guy that's doing it. You can see the trades that they do. Essentially, they're doing what I would do. They're making money, selling premium, and they seem to be doing a good job at it. And I think we will make money on most of these, but there is the risk of the underlying. So there's certainly safer ones, like ones that are index-based or ones that have a basket of stocks or ones that sell multiple tickers. Your biggest risk is going to be in the single ticker ones like MSTY, Tesla, those ones are going to be the toughest ones because they could lose all their money. So be careful out there, but just know, I don't think these are a scam. They're just a different approach. Can you beat it doing something else? Sure, probably, maybe. Are you going to be able to do the other thing? Maybe. There are some really good investors out there. There are people that can buy and hold, diamond hand it, but then there's people that just like to sell that premium and make that income. I think that's all I've got for you for this video. If you have any questions about this stuff, put them in the comment section. Let me know. We'll do another video on it if we got to do a better explainer. But I think I touched on everything that I needed to touch on there. If you own these, be sure to check out the last video that I did where there's a spreadsheet that will track your dividends. Really, really cool stuff. It looks like this, and you can track your shares and what your current dividend is going to be each month based on what the dividend is paying out, and you can track how many weeks until it's paid back. Really neat stuff. Check out that video where I talked about it and where you can get it. Good luck out there, and we'll see you again soon. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.